Okay, good day everybody. Welcome to the Investing Idea show. So today we have some interesting news that we will take a look into. First of all, I want to define what is a growth stock and what is a value stock in my humble opinion. So right now I'm here on Investopedia, which is the holy Bible site for every investor to learn the terms and basic principles of investing. So the first paragraph, which describes value stocks and growth stocks, goes like this. Growth stocks are considered stocks that have the potential to outperform the overall market over time because of their future potential, while value stocks are classified as stocks that are currently trading below what they are really worth and will therefore provide a superior return. And now if we scroll down a little bit and read a few more paragraphs. So the concept of a growth stock versus one that is considered to be undervalued generally comes from the fundamental stock analysis. Growth stocks are considered by analysts to have the potential to outperform either the overall markets or else a specific sub-segment for a period of time. And value stocks are usually larger, more well-established companies that are trading below the price that analysts feel the stock is worth, depending upon the financial ratio or benchmark that is being compared to. For example, the book value of a company's stock may be $25 a share based on the numbers of shares outstanding divided by the company's capitalization. Now I'm actually in Merrill, Bank of America company's website that gives the definition of what is a growth stock and what people tend to look at in a growth stock versus a value stock. So number one, a growth stock usually is higher priced than the broader market. Investors are willing to pay high price to earnings multiples with the expectation of selling them at an even higher price. The second part being that high earnings growth records. While the earnings of some companies may be depressed during periods of slower economic improvement, growth companies may potentially continue to achieve high earnings growth regardless of economic condition. And the third part being that they are more volatile than the broader market. The risk of buying a given stock is that its lofty price could fall sharply on any negative news about the company, particularly its earnings disappoint Wall Street. And the three major parts that are defined as a value stock is that they are lower priced than the broader market. The idea behind value investing is that a stock of good companies will bounce back in time when the true value is recognized by other investors. Second point being the price below similar companies in its industry. Many investors believe the majority of value stocks are created due to investors overreacting to recent company problems. And the third part being is that they carry somewhat less risk than the broader market. However, as they take time to turn around, value stocks may be suited to longer-term investors and may carry out risks of price fluctuation than growth stocks. So, we have read through the description of value stock and the growth stock from Investopedia and Bank of America. And while I actually agree with most of what they're saying, I define a value stock and a growth stock a little bit more different. So I believe that a value stock is not always considered a stock that has experienced some sort of a major drawdown in the market and that it's actually selling for less than its book value, or whatever kind of negativity has come out about the stock or something like that. I believe a value company is a company that has proven itself to the broader market with their specific service or a product, and this is a company that should be at least 20 to 50 years old. And everybody knows the company, it's already well established, but the thing is that because it's a value company and it's already big and well established, is that it typically experiences a lot less growth. And the growth stock is usually a small or mid-cap company, usually until like 15-20 billion in size. Once they come out with a new product, service, that it's actually not as hard to move the stock, and that's why it becomes more volatile. If you get a new partner, like a big bank or a corporation that can put in like $500 million in the company, its market cap is going to increase drastically, its stock price is going to increase drastically. So that's why the growth stocks are more volatile. But why I only invest in value stocks? I say only invest, but actually I do have some growth stocks in my portfolio as well. But generally, I stick to value stocks. At least 80% of my portfolio is in value stocks and in value stock ETFs that usually look at these big kind of companies already well established all over the world. Value stocks, because they've operated for so long, they have a lot more cash that they can play around with. And value stocks and value companies are led by people who are a lot more conservative, and they usually do not recognize that there's a strong competitor in the market for a lot longer than they should. So General Motors with Tesla is one example that I wanted to go into today. So in 2022, General Motors Hummer, the electric vehicle edition, will be launched. And although this is a really good sign for the company, I believe, and in my humble opinion, the vehicle looks awesome and futuristic. But the thing is that General Motors was a value company, and still is a value company, but it just took a lot longer to understand that Tesla is nothing to sneeze at, that they should take the competitor seriously. A growth company, for it to be able to generate funds, they only have a few options. One is that they can dilute the shares of their investors. So I have a few examples over here, and I'm just gonna go into two of them. So this is the income statement, for Square. As you can see down the last section where there's shares diluted, you can see that from 2017 to today's date, they have diluted their shares more than 24%. That's in about 3-year period. They have increased the number of shares they have total by 23%. And that's the primary way a newer company can generate funds, is that they hype up the stock price. People get all interested in the stock. A lot of newer investors typically get into the stock, drives up the stock price, and then the company can dilute the shares and take the money, invest in the projects that they have going on, give up some sort of a proof of concept, and then rinse and repeat until they have a project that can actually earn them money. And right here, we actually have Apple stock. A lot of people do say that Apple is a growth stock, but I believe it's both value and a little bit of a growth stock as well. But still, in the same time period, from 2016 to today, they have actually decreased their total number of shares by minus 20%. So you can see that the well-established value companies that have experienced a lot of growth, and they have already a lot of money ready to be deployed in new projects, they don't have to raise money in the same way that growth companies have to. So when these big already well-established companies understand that their smaller competition is nothing to laugh about, they can allocate a lot of money to fight it off. So actually, when a value company does decide to fight against their competition, they can do it a lot more effectively. The Hummer electric vehicle, its starting price in 2022 will be $80,000, and it's supposed to be a direct competitor against the Tesla Roadster. But the Tesla Roadster will cost $40,000. So the starting price for the Hummer is going to be double the price of a luxury Tesla Roadster. So this just proves that because General Motors have most of their equipment based around making diesel, that it's more expensive for them to make an EV that earns the money per vehicle. And because Tesla, from the day of inception, they have concentrated all of their funds on making these giant gigafactories that make only electric vehicles, their operating margins are always going to be a lot bigger than these already well-established car companies, which haven't had their primary focus on EVs. I believe that Tesla is a car manufacturer killer, but not to the extent that the Tesla fanboys think. I believe Tesla will kill off the companies that were already in trouble. One popular example is with the French manufacturer Renault. I don't know how to pronounce the word correctly, but the car company had massive amounts of debts already before Tesla got really popular. And now they would have to take on even more debt just to rearrange their equipment so that they could make an effective electric vehicle. So car companies like that probably are going to go extinct because of Tesla. But the car companies that have okay-ish earnings, that are not swimming in debt, I believe that these are going to bring a lot of competition to Tesla. So the Hummer, even though it's more expensive than the Tesla Roadster, it has a lot of cool stuff going for it. So one of the major things that I really like about this car is the crab walk. I mean, its front and back wheels can drive sideways. So I believe that the crab walk is a cool concept. I don't really see real life uses for it, but don't take me seriously for that. I'm not a big car specialist. I don't drive to exotic places. I usually drive my old BMW 416 inside the cities. And so just because I don't see a use for the crab walk doesn't mean that it's not there. There's actually some other really cool things going for the Roadster, and I've written it down on my sheet. So first of all, it's going to have 1,000 horsepower, and because of this, it can go from 0 to 60 miles per hour in 3 seconds. Then it has a 350 mile range, and the statistics, they're really similar to Tesla's. So rich people will have the option to take either this more of a luxury car or a Tesla. And I think that rich people, they usually don't like to own the same kind of stuff that the average household can afford. So just because the price point is going to be bigger than the Tesla Roadster, as weird as it sounds, I believe this is going to be advantageous for the GM's Hummer, because rich people will want to buy something different than a lot people can afford. Because if a Tesla vehicle costs around $30,000, a lot more people can afford it. And how else will you be able to flex on your peers if you don't own something that they cannot afford? But still, even after all these positive news for General Motors, I still would not invest in the company. So let's just jump to the income statement for it. And I'm in QuickFS. This is a site that I use to look at a company's past 10-year performance. And you can see here in the net income that their net income has been all over the place, ranging from minus $3.8 billion to 9.4. Right now it's sitting at 1.7. It's of course it's due to the COVID situation, but still, I don't like to see these kind of fluctuating numbers. I think it's, if a company cannot produce stable numbers every single year, then I think you should look at it twice before you actually invest in it. Balance sheet wise, it's actually a pretty solid company. I like to look at the total assets minus the total liabilities, and the company actually has more assets than its liabilities. The other thing that I like to look at is the total current assets. They should be more than the long-term debt. So the company passes both of these, but just because of the earning fluctuations, I don't know how stable the company is. So if a company has bad years, their stock is going to plunge. If they have good years, their stock is going to increase. And I don't like a fluctuating company like this. Their price to earnings has been on a roller coaster as well. In 2011, the PE ratio was 3.45. Then it went up to 14, then minus 14, now it's sitting at around 7. I probably will not invest my money into General Motors, but I like the product, I like what they're doing, I like they're finally giving Tesla some competition. So, good on them. So the other thing that I wanted to go into is that JP Morgan Chase takes on Square and PayPal. With smartphone card reader, faster deposits for merchants. JP Morgan's new Quick Accept service lets businesses take card payments within minutes, either through a mobile app or contactless card reader, and users will see sales hit their Chase accounts on the same day. Fast funding is offered free, unlike competitors including Square, which typically take a day or more and charge 1.5% fee to make their instant transfers. If you were to ask me if this is going to kill off Square, then I would probably say no. I believe that both Square and JP Morgan, they have a lot going for them in the future. JP Morgan is the most well-established bank in the world, one of the oldest banks in the world. It's another example where they didn't take their competition seriously enough, But now after 10 years, they've seen the growth of Square. They've seen that they can disrupt the market, and they basically have to fight against Square. But even before this news that JP Morgan is actually fighting back, introducing their quick accept, I would still think it's funny that people actually thought that it's going to kill off banking. As I already mentioned, these organizations, they have so much money that they can introduce a new product line in a really short amount of time. So now, even though Square had the upper hand against JP Morgan, so I believe that now Square will be kind of forced to become a bank, and these companies will become more like each other in the next 5 to 10 years. So that is going to be it for this video, and I hope you enjoyed, and see you in the next one.